Let's bring in CNBC senior economics reporter Steve Liesman, along with David Zervos, chief market strategist at Jefferies, here on set with me. Welcome to you both. Dave, let me just kick things off before we bring Steve into this and talk about why you think this is a moment where, we can be off to the races with rate cuts. We can be off to the races with positive market expectations, and all of our worries are kind of behind us.
Well, I don't know that all of our worries are behind us. I liked what Austin said today. I think they should be always on the lookout for things that are going to go wrong. But it's nice to have them in a position, Kelly, where they can react to the economy going into a darker place. When inflation's high and they have to fight inflation, they sort of leave the unemployment and the growth besides or on the side a little bit because they're fighting that fire. And that's where we've been for 2 years. And I think what Jay really told you on Wednesday last week was that they're sort of pari passu again, that inflation and growth in the reaction function, in the sort of objective function of the Fed, they're sort of back to normal, and they can be a little more responsive to economic downturns. And I think that really changes a lot of the look for risk assets as we go into next year.
Listen, you've been vindicated. They've been vindicated by a lot that's taken place this year. Where would you say your concern, in what direction does it lie for 2024?
So, I think part of like, we didn't know SVB was going to happen in March. It was, okay, something hits us. And the Fed, I think, reacted very interestingly to that. They used the balance sheet, not rates, to handle that. And that may be what they do again if it's a problem in commercial real estate or something like that. But I think the rate tool is now more available to them in the event that something like that does happen, or something in geopolitics with Taiwan and China. There's so many you can list off. The thing is, we just don't know. It's like supply shocks that hit us, whether it's Ukraine war, whether it was zero COVID in China. There's just lots of things that can hit. And it's nice to have the Fed back on our side.
But basically, you think coming through COVID and a lot of the things that they've done and tried, that they're going to do much more in the way of kind of special lending facilities and things like that going forward than necessarily cutting rates to respond to a shock.
Yeah, I think we learned this with the ECB, with their TPI program to help the peripheral bonds. The UK, the Bank of England did it last October when the gilt market went into a bit of a tailspin. They used funding facilities and balance sheet expansion targeted toward the zone that was going into the red, rather than giving the entire economy rate cuts. And I think that's where we're headed with the Fed backstop more, when it's very specific to a sector or an area. If it's the overall economy and the unemployment rate's shooting up to 4.5% and things are getting messy quickly, of course rate cuts come into the
So all of that said, and of course you're right. I mean, I think they've looked at these tools and said, wow, in some cases we barely have to use them and it achieves our desired result. But so do you then think we need 4 or however many rate cuts next year, just based on inflation and everything that's been happening?
Look, the sell side loves headlines. They love to see their name in lights. And so I remember after SVB, I think one of my competitors who you had up on the screen beforehand, they were calling immediately for 3 or 4 rate cuts very quickly. We stayed very pat after SVB and said, this is a very specific thing. It's not rate cut territory. It's very specific to a couple of banks that don't know how to manage their mortgages. And, it'll come and go, but the market always swings more, and the sell side loves the forecast
I admit,
more.
I was surprised to see Goldman one of the first out of the gate here, because Jan has been much more reserved.
Yeah.
Not one going for big. If anything, his headline has been, I don't think there's going to be a downturn. He's kind of followed the Fed more than led them, and so that one in particular stuck out to me. That why suddenly he's
they were pretty quick, if I remember, on SVB too. So I think they were very quick on that. Look, I've been in this business for 30 years. I've watched the sell side, been part of the research, part of the trading side. What I've learned in watching all my competitors on the sell side is people love their name in lights with a big number next to it, like 5 or 6 or 7, and then they forget about it and they move back the other way. So I thought all the presidents that you've had on and governors that you've had on and who've spoken afterwards presented a very, I think, cogent, more reasonable assessment of what 2024 is.
Interesting.